Imagine, imagine you're house hunting. You're looking around and you find this structurally sound, beautifully designed estate in just a highly desirable neighborhood.
Right, the dream scenario.
Exactly. The bones of the house are cutting edge. But there's a catch. The previous owner left the front yard an absolute catastrophic disaster zone.
Oh, yikes.
Yeah, I mean, trash everywhere, the landscaping is totally ruined, and it just looks terrible from the street. But because it looks so bad, the house is trading at a massive 50% discount.
Wow.
Right, so it's an ugly mess right now, but the discount is already fully baked into the asking price. And you are essentially getting the underlying architecture for an absolute steal.
Right, because everyone else is just staring at the trash in the yard.
Exactly. And in the financial markets, that dynamic is called, well, pricing in a disaster. And today's source text argues it is the exact reason you should be looking at a heavily burdened, multi-billion-dollar semiconductor ecosystem. So welcome to today's deep dive.
Glad to be here.
We are unpacking a very specific, honestly incredibly dense piece of investment analysis today. Our source is this brief note, simply titled eingefügter Text.
Yeah, which literally just means inserted text.
Right. It's essentially just a few sentences, but it is packed with high-level strategy, advanced market psychology, and a totally fascinating thesis on how to play a massive technological leap.
Yeah, it reads like the unfiltered late-night notebook scribbles of a brilliant market strategist.
Totally.
It completely bypasses all the polished corporate jargon and just goes straight for the throat of the financial mechanics.
That we love.
Exactly. Complex, unstructured notes like this, they often conceal the most valuable alpha precisely because they don't hold your hand. Like, they assume you already understand the macro environment and they just point out the structural inefficiencies.
Which is great for us to dig into. So our mission today is to evaluate the text's thesis, which is centered around what it calls the SKC ecosystem. And this operates within the emerging frontier of glass core substrates.
Right, a really cutting-edge space.
Yeah. And the text lays out two central players.
Yeah.
You have the heavyweight anchor taking the massive capital risks, and that's a company called SKC.
Yep.
And then on the other side, you have a much smaller, highly specialized support player called HB Technologies.
Two completely different companies.
Right. Playing entirely different roles in the exact same technological transition. And they offer two distinct philosophies on how you allocate your capital.
It is a textbook case of having to choose between, the gold miner taking the massive geological risk or the merchant just sitting there selling the picks and shovels.
The classic setup.
Right, and the source makes a highly specific argument for how to navigate the risks associated with both.
Okay, let's unpack this. We have to start with the heavyweight, SKC, because, well, the gravitational pull of the anchor dictates everything else in the ecosystem.
Yeah, you have to understand the giant first.
Exactly. So the text identifies SKC trading under ticker 011790 as a glass-cored substrate leader. Now, to fully grasp why this matters for you as an investor or just a learner, we need to look at the physical reality of what a substrate actually is.
Right.
And why the industry is pivoting so aggressively toward glass.
Right, because it's a huge shift.
Yeah. Historically, the semiconductor industry has built chips on organic materials like plastics and resins. But chips are getting so dense and running so incredibly hot that those legacy organic boards they're hitting a physical wall.
They literally warp under the thermal stress.
Oh, wow. Really?
Yeah, I mean, if you pack too much processing power, say, for advanced AI applications onto an organic substrate, the heat physically bends the material.
That sounds bad.
It's terrible. It cracks the microscopic connections. Glass, on the other hand, is just a total game changer here.
How so?
Well, its thermal expansion perfectly matches the silicon dies placed on top of it. It remains rigidly flat under extreme heat, and it allows data signals to travel significantly faster with way less signal loss.
So it's basically the holy grail of next-generation semiconductor packaging.
Exactly. It's the holy grail. But securing a leadership position in that holy grail is wildly capital intensive.
Right. Which perfectly aligns with the next major detail in the source. SKC has secured GPS ACT funding and maintains a market capitalization of roughly $5.5 billion.
That's a serious footprint.
Yeah, so you have a massive company recognized as a frontrunner in a critical next-gen technology, backed by direct government funding aimed at securing the global supply chain.
Right.
I mean, the macro tailwinds seem incredibly favorable.
On paper, yeah. The thesis sounds incredibly robust. You have the total addressable market expanding, the physical necessity of the technology is proven, and the capital injection is fully secured.
And here is where the text takes a hard, totally unfiltered left turn. It bluntly describes SKC's current financials as a, quote, dumpster fire.
A dumpster fire. You don't see that in official reports often.
You really don't. It attributes this mess to a copper foil EV legacy drag. So you have this shiny, futuristic glass substrate division, right? But it's trapped inside a balance sheet that is actively bleeding cash.
What's fascinating here is the market psychology embedded in that exact assessment.
Tell me more about that.
Well, companies like SKC often have these older legacy business divisions. In this case, they are heavily exposed to copper foil, which is it's a critical component in electric vehicle batteries.
Okay, so tied directly to EVs.
Right. And as you probably know, the broader EV market has been going through a severe cyclical slump lately.
Yeah, sales have definitely cooled down.
Exactly. So when demand for EVs slows down, the entire supply chain gets glutted with excess copper foil. Margins absolutely collapse, and that division becomes this massive anchor weighing down the entire company's profit and loss statement.
Like the trash in the front yard of our house analogy.
Precisely. Every institutional investor looking at SKC can see the bleeding. It's obvious.
But wait. How do you justify taking a position in a $5.5 billion company when its own balance sheet is a disaster zone? I mean, is it just blind faith?
Not at all. The text specifically argues that this EV drag is bottoming and that the messy financials are already priced into the market cap.
Priced in. Okay, let's break that down for the listener. What does bottoming actually mean in this context?
Right. So when a strategist says a cyclical market is bottoming, they're basically identifying the point of maximum pessimism.
Like it literally can't get any worse.
Exactly. In a commodity market like copper foil, supply gluts eventually force production cuts, right? Inventories slowly clear out and the cycle resets.
Okay, that makes sense.
And priced in means that $5.5 billion valuation already reflects the absolute worst case scenario for that EV division. The market has punished the stock so severely for the dumpster fire that any incremental improvement, like literally any slight clearing of the copper foil inventory, represents massive upside.
So you are buying the asset at peak ugliness.
You're buying it when nobody else wants to look at it.
That brings us to the comparative advantage the text highlights, which honestly I think is the most sophisticated point in the entire note.
Yeah, it's a great point.
The source doesn't just look at SKC in isolation. It compares them to their American competitors. It explicitly states that SKC is, quote, better than U.S. companies with $6 billion plus in dilution.
That is a massive distinction.
Right. Let's really drill down into why the author views SKC's operational mess as vastly preferable to the capital structure of its U.S. rivals.
Right.
Because a $6 billion dilution sounds terrifying.
It is terrifying. If we look at the mechanics of how U.S. semiconductor companies are funding their own transitions to glass substrates, building these massive new fabrication plants, they're raising capital by issuing massive amounts of new stock.
So they're just creating more shares out of thin air.
Exactly. That is equity dilution. When a company issues $6 billion in new shares to build a factory, they are fundamentally altering the ownership structure of the business.
I see.
The pie doesn't get any bigger, but it gets sliced into millions of extra tiny pieces.
So even if those U.S. companies execute perfectly, right, like they build the plant, they master the glass technology, and they hit all their revenue targets, the earnings per share for the existing investor are just permanently crushed.
Yes. The underlying value has been structurally diluted.
Wow.
That is the core tension the source is highlighting here. It is comparing temporary operational pain against permanent structural wealth destruction.
That's a great way to put it.
Right. A cyclical slump in an EV copper foil division, it hurts the balance sheet for a few quarters, maybe a couple of years. It's an operational headache.
Sure.
But dilution is forever. Once those new shares are out there on the open market, your percentage of ownership is permanently reduced.
So the author's making a really calculated bet here. They're saying enduring the volatility of a bottoming legacy business in a fully funded company like SKC is mathematically superior to buying a clean balance sheet that is actively shrinking your ownership stake by $6 billion.
Exactly. It is such a vital distinction for anyone analyzing these markets. The market is so easily spooked by a bad quarterly earnings report driven by a temporary cyclical drag,
Right, people panic over one bad quarter.
Exactly. But those same investors will blindly accept massive equity dilution if a company paints a pretty narrative about the future. The text cuts right through that illusion.
SKC is the heavyweight, taking the pain up front, but preserving the underlying equity value.
Which naturally leads us to the alternative strategy. Because if taking on the massive capital risk and surviving the dumpster fire is one way to play this ecosystem, the text offers a completely inverted strategy through its second player,
Right, the shovel seller.
the shovel seller.
So we are looking at HB Technologies, trading under ticker 078150. And the text paints a completely different picture here.
Totally different scale.
Yeah, HB Technologies has a market cap of roughly $250 million. They are a tiny fraction of SKC's size. Their specialty is automated optical inspection, and the text specifically notes they are, quote, piggybacking off of SKC Epsolics.
That word piggybacking is doing a lot of heavy lifting there.
It really is. Finally, the source concludes that HB seems like a lower risk, low price play, so low price to earnings, because, quote, yields for glass is going to be pretty important.
The ecosystem dynamics are just on full display here. SKC takes the billions in government funding and builds the massive fabrication plants.
The big scary stuff.
Right. And HB Technologies quietly walks in the back door and sells them the exact equipment necessary to make the plant actually function.
But hang on, I have to challenge the text's assertion here that HB is somehow the safer bet.
Okay, let's hear it.
The text explicitly calls this a lower risk opportunity. But if HB is a $250 million company entirely tethered to SKC Epsolics for this substrate play, and SKC is currently trudging through an EV market dumpster fire while trying to solve next-generation physics problems, HB is standing right in the blast radius.
You're not wrong.
Right. If the giant stumbles, the little remora fish attached to it goes down too. How is that structurally lower risk?
If we connect this to the bigger picture, the differentiation really lies in capital exposure and valuation margins.
Okay, explain that.
You are absolutely correct that HB's revenue in this specific vertical is highly dependent on SKC successfully building those facilities.
Yeah.
But consider the capital expenditure required from each company. SKC is taking on literal existential risk. They are building multi-billion-dollar physical infrastructures, navigating intense government compliance, and literally inventing proprietary chemical processes.
Which takes a massive amount of cash.
Huge amounts. Meanwhile, HB Technologies is just building specialized optical inspection machines. Their research and development overhead is a tiny fraction of SKC's. Their debt load is almost certainly lower.
I see.
If the glass substrate market gets delayed by, say, 2 years, SKC burns billions in carrying costs.
Yeah.
HB. They just pivot their inspection machines to other advanced manufacturing clients to keep the lights on.
Oh, wow. That makes the low P note in the text incredibly relevant then. Because in a sector dominated by hype and these massive forward-looking valuations, finding a company trading at a low price to earnings, multiple acts as a margin of safety.
A huge margin of safety.
There is no speculative bubble baked into HB's stock price. The market isn't pricing them for absolute perfection. They are valued based on their actual current ability to generate cash flow.
Right. A low multiple in a high-growth sector usually means the market is just completely ignoring the company.
Which is an opportunity.
Exactly. It heavily limits the downside volatility. The risk of the anchor client facing delays is heavily offset by the fact that you are buying HB at a fundamental discount.
But, the valuation only matters if the product they're selling is indispensable.
Very true.
Which brings us to the operational crux of the entire thesis. The text says yields for glass is going to be pretty important.
Yeah.
It sounds like a massive understatement. But in the context of advanced manufacturing, the concept of yield dictates literally life or death for a fabrication plant.
It's everything. In any semiconductor or substrate manufacturing process, yield is simply the percentage of usable, defect-free products that actually make it off the assembly line.
It's the ultimate metric of success.
It really is. You can have the most advanced technology in the world, but if your yield is 20%, meaning 80% of everything you manufacture has to be thrown straight in the garbage, your profit margins are mathematically obliterated.
And when we bring that back to the physical realities of glass, the challenge becomes terrifying.
Oh, glass is a nightmare to work with at that scale.
Right, because glass is inherently brittle. You're dealing with microscopic circuitry, chemical etching, and thermal bonding on a material that is highly prone to microfractures, chipping, and latent stress.
Exactly.
When a fabrication plant is layering copper traces that are literally narrower than a human hair onto a sheet of glass, the slightest anomaly ruins the entire batch.
The difficulty scaling this from a controlled laboratory environment to mass production just cannot be overstated.
I can imagine.
In the early stages of commercializing glass substrates, yields are notoriously horrific.
Like single digits.
Sometimes, yeah. The manufacturers are essentially flying blind. They're trying to tune a highly volatile chemical and physical process at incredibly high speeds.
Which is exactly why HP Technologies' specialty automated optical inspection is not just some nice-to-have accessory.
Yeah.
It is the absolute bottleneck for survival.
Precisely. If you are running a production line turning out thousands of substrates an hour, human eyes are completely useless.
Right, you can't just have a guy looking really closely at it.
No, you cannot manually inspect for defects measured in nanometers. Automated optical inspection uses high-speed machine vision, advanced sensors, and complex algorithms to scan every single millimeter of the glass in real time as it moves down the line.
Oh, wow.
Yeah, it detects the microscopic cracks, it maps the exact location of the thermal stress, and it feeds all that data back to the engineers instantly.
So it provides the necessary feedback loop to actually fix the yield problem. Because without automated optical inspection, SKC literally cannot optimize the manufacturing process. They would just be blindly throwing away millions of dollars in defective glass every single day, just hoping the next batch magically comes out better.
And that is why the author of the source text recognizes that HP Technologies holds the keys to the kingdom.
It really is the picks and shovels.
Yes. SKC has to solve thousands of complex physics and engineering problems just to make their multi-billion-dollar bet pay off. HP Technologies just has to provide the camera that takes a picture of the problem.
That's incredible.
As the source so mildly puts it, yields for glass is going to be pretty important. If you understand the mechanics of advanced manufacturing, you know that is the understatement of the decade. SKC has absolutely no choice but to buy what HP is selling.
It is just a phenomenal breakdown of how to approach an emerging technology.
It really is.
You have one highly concentrated node presenting two distinctly different avenues for capital allocation. Path A is the macro-level, risk-tolerant play.
Right, go in with the jump.
Yeah, you take a position in the heavyweight, SKC. You accept the volatility, you look past the ugly EV legacy drag,
Right.
because you understand that the massive GPS Act funding secures their runway.
Yeah.
And, crucially, their operational pain is vastly superior to the permanent structural dilution destroying their competitors.
Yep.
You are betting that the dumpster fire is fully priced in and the upside is enormous.
Exactly. It requires a really strong stomach for volatility and a deep belief in the eventual clearing of that commodity cycle.
Right. And then you have path B, the value-oriented supply chain play.
It's shovel seller.
You look at the $250 million company operating quietly in the background. You avoid the existential capital expenditure risks of building the actual factories.
Yeah.
And you bet purely on the operational reality that manufacturing glass is going to be a total nightmare of quality control.
Which it will be.
So you position yourself in the low multiple company whose technology is literally the only thing standing between the heavyweight and catastrophic yield failures.
It is the ultimate structural arbitrage. You leverage the massive capital spend of the giant without having to actually fund it yourself.
So we've broken down the mechanics, the thermodynamics, the cyclical drags, and the incredibly vital importance of manufacturing yields. And now we want to turn the lens back to you.
Yeah, what do you think?
When you look at an emerging multi-billion-dollar ecosystem like glass substrates, what stands out to you? Are you drawn to the giant weathering the storm, absorbing the macro-level risks to secure a monopoly position? Or does your strategy align more with the quiet specialist, the supply chain operative, just making sure the entire multi-billion-dollar gamble actually works?
It is the defining question of tech investing.
Yeah.
And I want to leave you with a final thought that extends far beyond the mechanics of SKC and optical inspection.
Okay.
If the logic of this source text holds true, if the true highly leveraged alpha in a volatile new sector is found by focusing purely on the critical manufacturing bottlenecks, it fundamentally shifts how you should evaluate innovation going forward.
In any sector.
In any sector. The next time a massive technological paradigm shift dominates the financial news and the market rushes to evaluate all the massive companies taking on all the dilutive financial risks, pause.
Yeah.
Ask yourself, where are the hidden low valuation companies quietly waiting in the supply chain to inspect, verify, or facilitate the process? Because while everyone else is aggressively bidding up the price of the gold mine, the most asymmetrical returns are almost always found by finding the sole distributor of the magnifying glass.
It completely reframes the architecture of financial analysis. The beginning of our deep dive, we talked about how comforting a clean, perfectly balanced ledger can be. But as we've seen today, the most lucrative insights are rarely found on a pristine balance sheet.
No, they're usually hidden in the mess.
They are uncovered by stepping into the messy reality of the market, understanding the structural difference between temporary pain and permanent dilution, and having the vision to spot the hidden players holding the shovel. Until next time, keep diving deep.